Hey everybody, it's John King with Summit Funding. It is Friday, the 1st of September, and I am super excited to come to you with this week's market update. Why am I so excited? Because change is upon us, and change can be really, really scary, and I want to help guide you through it. So we can all think back to lots of different times in our lives when we've dealt with change. Every time you're on a path and you have to change to a completely different path, there's a lot of fear. There's a lot of uncertainty. There's a lot of turmoil. And that's exactly what we're dealing with in the housing and real estate market and in a mortgage market right now. We're dealing with a lot of change. We're dealing with a lot of turmoil. We're dealing with a lot of uncertainty. So first and foremost, the Federal Reserve is in the middle of changing their thought process on what's going to be happening with the markets. Now, what's that change? Well, let's see. For the last almost year and a half, the Federal Reserve has been raising interest rates every single month. And they've been doing that every 6 weeks. They've been doing that simply because they've tried to control inflation. We're dealing with some major economic issues. Everybody's paying more for everything, and the Federal Reserve has had to make things more expensive. It's created a challenge with mortgages. It's created a challenge with just the normal stuff that you're buying at the grocery store. It's created a challenge with your credit card debt. And the Federal Reserve has to walk a very, very fine line. The fine line is they need to keep it clear that we're going to fight inflation no matter what it takes. The problem is they also don't want to push too hard. They don't want to raise interest rates too much because then they'll throw us for sure into a recession. They actually have a shot at getting into what's called a soft landing where, hey, they're going to bring inflation down and it's not going to crash the economy. It's not going to cause significant unemployment. The hard landing is if the Fed brings inflation down, but the economy crashes. We end up in a recession. Some might argue that we're already heading into that recession. I last year thought for sure we're going to hit a recession. I'm not so positive because there's actually a third option right now, which is no landing. So what does no landing mean? It means inflation never actually hits the Fed's target of 2%. And the Fed might just be silent about that. They might just say, you know what? I'm okay with inflation being higher than what it has been historically. And the fact is we went from 2010 to 2020, 21 with lowest inflation we'd ever had in years. We had to fight to actually get prices to go up. Inflation is good, by the way. You want a pay raise every single month, or not month, that'd be great every month, but every year you want a pay raise. You want to make more money. Well, the problem is that pay raise means that they have to charge more for the goods and services. So inflation is actually a positive thing. There needs to be some. But the question is, how do we handle this change? Because you're going to get mixed signals. This morning, the jobs report came out. So September 1st, the first Friday of every single month, they put out the jobs report. And we've been paying really, really close attention to jobs because jobs is really the telling story of whether the Fed can land this plane without crashing it, the soft landing. And this morning's job report had mixed signals. So the inflation number, the unemployment number went up, which you'd think, man, that's bad news for jobs. It means more people are unemployed. Well, no, because it's kind of a broken statistic because there's something called the labor participation rate. Now, what does that mean? It means what percentage of the people that are alive, that are of age to work, are actually actively wanting to work. And so you might be out of work and you were laid off during COVID and you decided, you know what? I can retire. I'm going to go ahead and retire because I just don't want to have to get back into the rat race. And this was just meant to be. It was time for me to get out of the rat race. And so you said I'm just not going to keep trying to work. I'm just going to live off of what I've got. So you are no longer part of the pool of participants looking for or actively working. But then you decided last month, you know what? I think I will go back to work. I think I'm going to start looking for a job. So now you've raised your hand and saying, hey, I'm going to participate. I want to play. Pick me for your baseball team. And so once you become a participant, then the statistics change. And they say, well, now you're considered unemployed. You've been unemployed for the last 3 years. But for the last 3 years, you said, nope, I'm not going to play the game. I'm not trying to find a job. So this month's unemployment went up, but it's mostly because more people said, you know what? I'm willing to look for work. Now, here's what I think is happening. I think people are running out of savings. And I think people are seeing their high credit card payments and their high credit card debt. And they're saying, man, I can't sit on the sidelines anymore and hope that things are going to work out. I better start looking for work again. So that is a sign of things changing. But things don't change simply overnight and say, oh, well, we're going this direction. Now let's turn and go that direction. The economy is a big ship. And to get a big ship that's heading one direction to go the other direction takes a lot of energy and effort to get that ship to turn. And in the meantime, it's pretty confusing because you get conflicting signals. You get signals that say, oh, the economy is going this way. Oh, the housing market's going that way. There are arguments right now about the housing market saying the housing market is doing just fine because prices are going up. Maybe, but maybe not. Maybe prices are going up because very few people want to buy and even fewer people want to sell. And so the few houses that are for sale, well, those prices are going up. So statistically, the housing market's fine because prices are going up. But that isn't the reality. The reality is the housing market is broken. And we're likely a year or 2 or 3 away from having an even halfway functional housing market. And that's the thing I've been saying over and over again is now is an opportunity for people who aren't a homeowner to say, you know what? Maybe I need to jump in now. If I can afford the payments, that's the key. If I can afford the payment, maybe I should jump in now. And I completely agree with that thinking. Why? Because you're going to spend more for the home when interest rates come down. And when I say rates coming down, we've been at 7.5% recently. I think when rates hit 5.5%, the floodgates are going to open. I don't think it's going to take a 4% interest rate or a 3% interest rate. I think we're going to see a lot more people coming back when rates hit the low 6s because they're now used to rates being in the 7s. I've talked a lot about recency bias. I'm not going to go that deep into it today, but very, very simply, we're dealing with a lot of confusion and a lot of fear. And Warren Buffett said, be courageous when others are fearful and be fearful when others are courageous. This is a moment in the housing market where people are fearful. If you have the ability to be courageous, you will succeed. A couple of things I want to talk about that you can focus on. First of all, if you are a first-time home buyer, I already mentioned why now is a good time to buy. If you own a home, you need to think long and hard about, is this the right home for me? Now, if you say, you know what, John, no, I want to move up, but I'm going to wait until rates are lower because, look, a rising tide floats all boats. When the house price goes up for the house I want to buy, the house price goes up for the house I'm selling, and it's still a wash. You're right. The challenge is, are you going to be able to get an offer accepted in that more competitive market? Think about that. Think about all your friends and family who tried to buy homes in 2020 and 2021 by selling their current home and buying another one concurrently. The word is contingent, being contingent on the sale of your home. That is not going to be as easy to do in the future, but it is way more common today. And the final thing I'll tell you is if you are a homeowner and you're happy in the home that you're in, but you're struggling with debt, give me a call. Because I want to help you before it's too late. I've talked to a lot of clients recently who it's getting too late. They've got the calls coming from the collector saying, hey, you haven't paid your bill. Their credit score is dropped. Now, I have solutions for those people with lower credit scores, but they're not as nice as they would have been if they had done something when their credit score was better. So if you know somebody in that position or you're heading down that road, please call me. It'll be a confidential conversation for me to help guide you and help you figure out what your options are. I really appreciate you listening every single week. I'm looking forward to taking great care of you and your family and your friends and anybody else you feel comfortable referring to me. Thanks and have a great weekend. Happy Labor Day. Bye-bye.